Hi, this is Alvin from Dr. Wealth. Yesterday, the Fed just raised another 0.75% interest rate, and it is not surprising because that was what the market expected anyway, that 0.75%. So, why did the market slump after the Fed has raised the interest rate according to the expectation? There's a big question mark for some of you out there. So, this is a video to explain that, and I also want to give you 3 signs why the recession risk is higher than ever before. So this is what happened yesterday on the S&P 500 in the US stock market. So the market was actually positive in the earlier trading session until the Federal Reserve came out with the rate hike, and suddenly the market reversed and down 2% for the day. That is measured by S&P 500. So why is this happening when the 0.75% is expected in that sense? So it is not so much about the 0.75%. It's actually due to the projection of the Federal Reserve's interest rate hikes in the next few months. Okay, and we can get a clue from the Fed's dot plot. Okay, so there is this thing called dot plot. Later I'll show you what it looks like. It is basically a chart that records each Federal Reserve's officials projection for the central bank's key short-term interest rate. So that is the definition, right? So basically, they survey all the officials and each will give a sensing, right? So what is the interest rate end of 2022? What's the interest rate end of 2023? So then they will compile everything and then they plot it out in a chart and present it to the public. So this is what it looks like, right? So there's many dots, and you can see that into different years from 2022 to 2025. Okay, and they even have a long run at the last column. So the dots are basically where the votes ended up on, and then you have a vertical scale, right? You can see the numbers on the right hand side, and I already label it in red so that you can see it a lot easier. So in June, right, the dot plot looks different from the dot plot in September. Okay, so within the 3 months, there was a climb in the expected or projected interest rate by this federal or the Fed's officials, right? So in June, they expected, the median expectation was 3.4%. Okay, so the Fed officials think that it would be about 3.4% interest rate Fed funds rate, okay, at the end of 2022. But then 3 months later, which is now in September, that expectation has risen to 4.5%. Okay, so that's almost a good percentage point, right, from 3 months ago. So it becomes a lot more hawkish, right? And then for 2023, it even went as high as 5%, right? Some of the Fed officials think that it might be 5% at 5% when we end 2023. When 3 months ago, the expectation was just 3.8%. So we can see that there is an overall hawkishness in the Fed's committee, all right, the members over there, and that is not good news for investors, because investors hope that the tapering would done, or at least they slow down this interest rate hikes. But it seems like they are getting more hawkish. Okay, so that will punish more of the growth stocks potentially. Okay, so that is one of the key reasons why I would think that the market went down. And it doesn't help when the Federal Reserve Chairman Powell said even harsher things, okay, as in the recent press release. So in May, 4 months ago, he was saying something along this line, right? He talked about soft landing. Okay, so even though in May he said that it is not 100%, right? It can be challenging for this soft landing, okay, but nonetheless he said that he thinks that there are pathways for them to get there. Okay, so there was still that sliver of possibility. Well, it sounds more positive, right? 4 months ago, and this is what he said yesterday. And I just quote, right? The chances of a soft landing are likely to diminish to the extent that policy has to be more restrictive. Okay, so it's trying to suggest that soft landing, you can actually stop talking about it from now on. The chances of it happening is much lower. And he added, high interest rates, slower growth, and a softening labor market are all painful for the public that we serve, but they are not as painful as for failing to restore price stability. So it is continuing that stand since August, the Jackson Hole meeting, that the Fed is going to be very clear about tightening. They are not going to loosen the grip, even if inflation is coming down, right? Their target is at 2%. So at 8.3%, there's still a long way to 2%. So they are going to be hawkish and aggressive till then, right? So this is the first sign of recession. The Fed has conceded a recession is more possible than before. Okay, so they also turn more bearish, right, as compared to 3 or 4 months ago, right? So that is the very first sign. And the second sign is that after the announcement, the yield curve inverted even further. Okay, so there's this concept called yield curve inversion in the economics. Okay, so they measure that this difference between 10-year and 2-year bond yields. So technically, a 10-year bond yield should be giving you a higher yield for the longer duration, and then the 2-year bond yield should be lower than the 10-year bond, right? Because it's a lower tenure, your risk is lower. But when a yield curve inversion happens, it means that the 10-year yield is lower than the 2-year yield, which makes the curve higher at the start, or the lower tenure, and then shorter at the longer tenure. And this is a chart that plots the 10-2 bond yield. So you can see the thick black line, horizontal line, right? And the graph is below that thick black line. That means that the yield curve has been inverting for many months. Okay, and it just got even more inverted after yesterday's announcement. So when a yield curve inversion happens, usually a recession will come. It may not come immediately, like next month or next year. There is a time span that may happen, right? So we don't know exactly when the recession will happen, but chances are very high, right? When there's an inversion that happens, recession is not far away. All right, so that's the second sign. And the third sign is regarding the logistic company. All right, so logistic companies have started to see poorer business. Okay, so the case in point is FedEx. Last week they make an announcement, right, talking about their targets are not going to be met. They are actually below. In fact, it was the first quarter results. Okay, the prelude to the first quarter result. It's not even first quarter result. They haven't really released it, but they wanted to give something like a warning to the public. And of course, the public didn't like that pessimism that the management was sharing, and that caused the stock price to tank 20% in just a day. Okay, so no joke, right? And in fact, the pessimism carry on. The management did say that the second quarter results are even going to be further away from the estimate, and then the entire 2023 estimates were just abolished. Okay, so they just stopped giving that forecast. So that is how bad it has become. But why singly I pick this kind of stocks out, right? There are so many other stocks that we want to look at. It is because the performance of a logistic company is a barometer for the economy, right? Because people buy stuff, especially online nowadays with e-commerce, trade. You need to transport goods from one country to another country. And if let's say these logistic companies are going to see less businesses, it's going to tell us that demand is slowing, right? And then trade is slowing as well. So all this point to a slower economic activity, and that result in potentially recessions happening. Okay, so it is a barometer, right? And that's why logistic company performances are an indication. Okay, so it is not looking good, right? And we look at other companies that are in the logistic field as well. UPS, okay, the stock price has been down 19%. The results for the latest quarter has not been released yet, right? Probably in the next few weeks or so, right? Another one is from Germany, DHL. It's down 43%, almost half gone. Okay, and these are DHL and FedEx are global logistic company, right? They send the goods all over the world, right? So they are really the barometer for global trade environment. Okay, so they are very indicative of what's going on in the ground, right? So it's not looking good at all. So these are the 3 signs of recession. Okay, sorry to break the bad news. I would think that more bad news will come, but these are the 3 at the current moment. So the first is that the Federal Reserve tone has changed. The pessimism has seeped in. That optimism is almost gone, right? And the Fed is trying to tell the public that a recession is possible, right? It is not confirmed, but it's possible, and they are not going to change course. Okay, they are still going to do their rate hikes because the chief number 1 enemy is still going to be inflation. They actually don't care whether recession is happening or not, right? So that stance has been getting more obvious at this moment. And second is that the yield curve is firmly inverted, right? It was already inverted a few months ago, but now it's even more inverted, deeply inverted. I don't know whether that will cause a deeper recession or not, right? I don't know whether the degree of inversion does have impact, but usually when a yield curve inverts, the chances of recession is very, very high. Okay, we just don't know when exactly, but it's not very far off from where we are right now. Third, logistic companies expect worse results, right? And in fact, their share price is very telling. Okay, they have dropped more than the index itself, and probably more poor results going to come in the next few quarters. Okay, so they are the barometer of the economy, and they're showing slowdown, severe slowdown, and that's not going to be good sign, and recession might just be around the corner. Okay, so I hope now you get a better sense of what's going around in the world, and if you need to do any preparations, right, especially in a recession period, hanging on to your job is the most important thing. Okay, as long as you have a job, you have a pay, your income, right, when investing is just a second thing, whether you do it or not. Okay, but securing income is a lot more important. Okay, so I hope that this is enlightening for you and find it informative, and you can do whatever preparation that you need to do. All right, so this is Alvin. I hope you like the video. Remember to subscribe to the channel, and I'll see you around. Goodbye.